This video is sponsored by Morning Brew. Click the link in the description below to sign up for their daily business newsletter today. Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin. Today we're talking about everyone's favorite subject, really hot topic for you finance fans out there, taxes. Today we're talking about taxes. You see, last week, Canada's federal government released its 2024 budget, which is more or less the government's financial blueprint for the year, which includes their planned expenditures and programs, as well as any tax changes. And this year, it included a change to capital gains tax, or the tax you pay whenever you sell an asset for more than what you bought it for, with this being something that applies to stocks, bonds, real estate, cryptocurrency, of course, and a number of other assets. And this change is something that got a lot of traction online, even surprisingly from American accounts, with a number of influencers and the like tweeting about this change on platforms like X. And while this Canadian change was followed by a proposal in the United States to increase their capital gains tax rate at the highest level to 44.6%, the highest it's been in over a century, Canada's change is perhaps more far-reaching within the country, given that America's high rate here only applies to individuals with incomes above $1 million and investment income above $400,000. And as a Canadian myself, I want to discuss this not only because it directly applies to my profession, will affect clients of mine and many other Canadians, so I think there's value in going over it and explaining the differences, but also because there seems to be a lot of confusion, some misinformation, and a whole lot of discourse, with some celebrating this as a tax against the wealthy, while others are lamenting it, with some going so far as to argue that Canada is a failed state, which I personally was devastated to find out. Joking aside, though, there are valid criticisms and concerns about this change, and it comes at a relatively tough time for Canada, given the rising cost of living and rising real estate prices, with real estate being a particular concern here in the country. So I want to post about this closer to home topic to try and clear things up. And I know Justin Trudeau, mixed feelings about him online, but really with today's video, not looking to be political, trying to be descriptive here rather than prescriptive, and highlight what's changing, why we're seeing this change, some of the concerns around it, as well as who is impacted, which is a really important one. And for my actual Canadian viewers, I'll finish this video with some tips at the end for how to manage through this change for anyone considering whether they should try and realize capital gains before this change in June or perhaps afterwards. But with all that out of the way, let's hop into the riveting world of taxes. We'll start off with an explanation of how capital gains tax currently works in Canada, since that seems to be where a lot of the confusion about this change was really stemming from. Currently in Canada, much like many other countries, capital gains receive a favorable tax treatment over your typical income, with the idea being that they want to incentivize people to invest in businesses rather than, say, just earning interest income. But unlike the United States, where there's a unique capital gains tax rate applied, Canada does things a bit differently, where you use your marginal income tax rate, the same as your earned income, but instead only tax a portion of your capital gain, with the inclusion rate currently being 50%. So if you bought a stock for $2,000 and eventually sold it for $3,000, your capital gain would be that $1,000 difference, and you would only apply your marginal income tax to 50% of that, or $500, meaning that effectively capital gains are taxed at 50% of your marginal income tax rate. With the 2024 budget, however, the federal government is proposing that we change the inclusion rate for capital gains tax from 50% or half of capital gains to 2/3 in 3 different circumstances. For annual capital gains earned above $250,000 for individuals, for all capital gains earned by corporations, and for all capital gains earned by trusts. So to be clear, Canada is not increasing its capital gains tax to 66.7%. It's increasing how much of your capital gains is taxed, the inclusion rate from 50% to 2/3, or 66.7%. In fact, after this change, the highest marginal tax rate you could possibly pay on your capital gains will still effectively be just 35.7%, again, at the highest possible level. And again, it's only in certain circumstances. So if you don't have any trusts, you don't have any corporations, and you're not expecting to annually see capital gains above $250,000, meaning that's how much you're profiting, you're not going to see a direct tax increase from this. Now, in circumstances where it does apply, there is a meaningful jump in taxes here of roughly 33.4%. Currently in Ontario, the highest marginal tax rate you effectively pay on capital gains is 26.8%. So that increase to 35.7% is meaningful, but still very different from the 66.7% tax rate that many were believing Canada is now going to see. So that's the change being proposed here. As for the justifications or why we're seeing this change, with higher spending on areas like real estate, where they're trying to tackle the shortage that we have. The government's going to look for higher taxes somewhere to help cover some of that. There is also a chance that this discourages some real estate investments and might even encourage selling before the June 2024 date that this takes effect. But the main argument being made by the government here is that this improves tax fairness, with the budget highlighting that top income earners usually earn more of their money from capital gains and can at times pay a lower marginal tax rate than even lower income earners. And according to the budget, only 0.13% of Canadians with an average income of $1.4 million are expected to pay more capital gains tax in any given year. Although that's a little misleading given that they're focusing on personal income taxes, even though the budget itself highlights that 307,000 corporations, or 12.6% of Canadian corporations, are likewise expected to be impacted. So obviously that's going to impact the people who own those corporations in addition to that 0.13%. And that amount is only who's impacted in any given year, not who will see an impact at some point over their lifetime, which would obviously be much higher. Regardless, those are the justifications for the changes being made here. Now, there are some exceptions worth highlighting here, as well as some additional relief being introduced alongside this increased inclusion rate. Obviously, real estate is an area that this would likely apply to, given that it's not uncommon to sell a property for $250,000 more than what you originally purchased it for. In Canada, we do have the principal residence capital gain exemption, meaning you don't pay capital gains tax when you sell your principal residence. Also, when it comes to small Canadian businesses and qualifying farm and fishing properties, we also have the lifetime capital gains exemption on the sale of the business or property itself, with the amount of that exemption increasing from $1.02 million to $1.25 million with this budget. And in addition to this lifetime capital gains exemption, business owners in certain sectors will also get access to a new Canadian Entrepreneurs Incentive, which allows an additional lifetime maximum of $2 million to have eligible capital gains recognized at a 33.3% inclusion rate. So basically, when people are selling their qualifying small business, there's $3.25 million of special treatment for capital gains on that. So that's really everything in a nutshell. And you might be wondering, why all the controversy? This seems pretty targeted at wealthier individuals. Most of us would be pretty lucky to have a one-year capital gain of over $250,000. Why all the hoopla? Well, for one, there are a few situations, especially when it comes to different properties, where you might have everyday people still being forced to pay higher taxes here, with the common one being highlighted being family cottages and summer homes. Obviously, most individuals don't designate their cottages as a primary residence, so not often exempt from capital gains tax. And if there's a situation where there's a deemed disposition, such as if the owner of the cottage dies or gives the cottage or passes it down to a family member, the CRA, or Canada's tax authority, will tax the capital gain on the property using the fair market value versus what you paid for it, even if you didn't actually sell it. With that, again, possibly reaching to this higher inclusion rate if the gain is above $250,000. Meaning that if the family wishes to keep the cottage and there isn't enough money in the estate to cover the tax bill, the beneficiary will have to cover the cost of this tax, which now, again, could be higher under these new rules. And some might view owning a cottage or certainly a summer home as a luxury. It's not always going to encompass higher income earners. There are obviously middle or lower income earners who might have a family cottage that this will apply to, especially in situations where families have held a cottage for a long period of time and might have a low cost basis. And given Canada's hot real estate market, that might apply a ridiculous valuation to the property. Now, the second concern comes around trusts, which generally speaking is a legal structure that allows assets to be managed by a designated trustee on behalf of a beneficiary. Something that might be used if, say, parents pass away and want to leave their kids an inheritance, but don't want to give them unfettered access to the money. And not only do trusts have a broad array of applications, including many non-high income earners, but they already in many cases pay the highest marginal tax rate possible on all income earned. So with a higher capital gains inclusion rate, this really seems to punish using the trust structure. And there are going to be unintended consequences of that, such as with qualified disability trusts, which are graduated rate trusts, meaning they don't only pay the highest marginal tax rate. They do have a graduated system, but they're naturally intended for beneficiaries who have a disability. So if there's not carve out or change for these special types of trusts, these people who aren't inherently high income earners could see a negative impact from this higher tax inclusion rate. Thirdly, on a similar note, this naturally makes corporations less attractive, which might sound like it's only impacting sort of those larger businesses. But in Canada, it's quite common for self-employed individuals, contractors, or other types of independent workers to incorporate as a way of tax deferral. You basically earn money into your corporation and pay a lower corporate tax initially, and then pay yourself a salary from there, which is when you pay your income tax. So it doesn't eliminate the taxes, but using this, you can better plan out your income. You can smooth it out so that you don't pay as high of a marginal tax rate. And while the money sits in the corporation, you can invest it and earn a better compounded return, given that you're benefiting from some pre-tax dollars. It's a really common tool, especially among certain professions like doctors. But now, with all capital gains within corporations being taxed at a more aggressive inclusion rate, that naturally makes it less of an attractive structure, with some feeling like this is a bit of a tax trap, given that they set up these corporations, paid the fees to have their money, take advantage of this planning, and now it's subject to this higher tax inclusion, which in a way touches on the last main sort of criticism of this budget change. Brain drain, with obviously there being a higher inclusion rate for wealthier individuals and corporations, which includes a number of Canadian entrepreneurs. Many have raised concerns that this will disincentivize these people from working within the country, which matters when these people are big contributors to economic activity, not only because of their own spending and investment, but also because if they're an entrepreneur or otherwise a business owner, with the jobs they create and the products and services they bring to the market, which is particularly prickly, given that Canada does currently have a productivity problem. Post-pandemic, we've seen a decline in Canada's real GDP per capita, as well as net real capital stock per person, meaning investments within the country in the economy's long-term growth is not keeping up with the population growth. So obviously anything that discourages business owners or large investors from operating or investing in Canada is not going to help that key issue. Same thing goes when you talk about doctors, with our country experiencing a doctor shortage. Lowering the attractiveness of this popular tax planning tool for doctors is not going to help attract more talent, with many people either sharing stories or just speculating that we're going to see a lot of people leave the country as a result of this. Now I have no predictive power over whether that's going to be a real issue or more talk than anything else. It is worth pointing out that we have had higher capital gains taxes in Canada in the past. The inclusion rate was 75% during the 1990s. And when it comes to corporations, after accounting for all the tax credits and deductions, Canada does still have the lowest marginal effective corporate tax rate among the G7, which might sound surprising, but Canada's high tax reputation comes on the personal income side. Small private corporations are actually taxed pretty favorably. And there is obviously a larger debate and discussion to be had about how much you incentivize this group of corporations, business owners, and whatnot to help support the economy versus how much you enforce a progressive tax system. But it's all something to consider when our country does have a productivity problem. So that's a summary of the tax change we're seeing in Canada, as well as the discourse and debate being had around it. Now, I do want to highlight the budget itself, not technically set in stone. There is still room for changes and carve-outs before the June 25th effective date for this change, but it's unlikely we'll see a full walkback of the policy, and we're still likely to see a higher inclusion rate for those situations highlighted. And for Canadians, it might lead you to believe that given this only comes into effect on June 25th, that you should be looking to sell your property and all your investments to realize capital gains at the 50% inclusion rate before you have to pay tax on 2/3 of the amounts you earn. But depending on your situation, that's not inherently the case. It is true that if you're going to be recognizing a capital gain in the near term regardless, then it might make sense to recognize before June 25th at this lower inclusion rate. However, there is still a benefit to tax deferral, even if you end up paying a higher inclusion rate, leaving that money in the account to grow and compound over the long term. There's actually this great tool developed by Looney Doctor Online, a fellow Canadian finance content creator who managed to squeeze this out not long after the budget was released. So kudos for that. But you can use this tool to analyze different scenarios to see if you have a capital gain on a property or an investment, whether you should recognize it before June 25th or afterwards when you have the higher inclusion rate. As an example, let's say you live in Ontario, you have a base income of $100,000, you have $300,000 in unrealized gains on a portfolio of investments, and you believe these investments will continue to see capital gains returns of 7% annually. Obviously, that's just an assumption that might be too high or too low. We're just using it for this example. With this tool, you can see that if you realize the capital gains now, meaning that you sell the positions to pay that tax liability, reset things before the 2/3 inclusion rate comes into effect, and then buy the investments back to continue earning 7%, you will see a better after-tax return compared to realizing the capital gains later if your time horizon is 9 years or less, meaning that regardless, you plan on selling the investments within the next 9 years. After 9 years, however, you can see that the opportunity cost of spending those tax dollars up front that could otherwise continue compounding in the account actually outweighs the cost of the higher 2/3 inclusion rate, meaning you'd be better suited not realizing the capital gains and just continuing to hold them if you can do so for 10 years or longer. And the longer you wait to sell, the larger that gap becomes, and the more sense it makes to not recognize the capital gain and to continue deferring that tax. Now, this depends on a number of different assumptions: where you live, your time horizon, the constituents of your portfolio's return, whether a corporation or trust is involved, all kinds of different stuff. And it's why there's no real rule of thumb about whether you should recognize a capital gain now versus after June 25th. There is also a chance that things again change before June 25th, or as we've seen in the past, the inclusion rate changes again in the future, for better or for worse. But hopefully this helps to demonstrate that there's still a benefit to tax deferral over the long term, even with a higher inclusion rate, which also applies to corporations. Yes, they're going to be a bit less attractive than they were before, still a pretty handy tax planning tool. And of course, we still have the tax deferred and tax-free accounts, the RRSP and the TFSA, which still provide a lot of tax benefits for people investing. And overall, whether this tax and all the other aspects of the budget to counteract it end up being a net positive or negative for the country, really outside the scope of this video, there are very real concerns and some indirect impacts that people could experience, say if employers do end up leaving the country, which we'll have to wait and see how real that risk is. But for most people who don't deal with corporations or trusts, who are employed and just saving money into their accounts, not going to see a direct impact from this change. Anyway, that's a video. Before I sign off, I do want to give a quick thank you to today's sponsor, Morning Brew. I've worked with them for quite some time now, and it's just genuinely because I like their newsletter, and I think they're a great free resource for viewers. Morning Brew publishes a business, finance, and tech newsletter that they send out 7 days a week to your inbox, covering the daily happenings and interesting market trends. For example, they recently covered the trend of subscription hopping in the United States, highlighting how 30 million subscribers have canceled at least 3 streaming subscriptions over the last 2 years, and how this group accounted for 40% of all new subscriptions and cancellations in 2023. It's something I've been reading for many years now, and I've always really enjoyed it, even from a career perspective, as it's always been a good summary of important headlines occurring in the business world, and I just really enjoy their style of writing. Newsletters are witty and by far one of the easiest and quickest reads of my workday, which is why they're one of the first things I go to in the morning, and they cover a lot of ground. And the best part, as I mentioned, completely free. And if you want to check them out and join the 4 million other professionals rating, you can click the link in the description down below. The process takes less than 10 seconds, and with there again being no cost, really no downside to subscribing. Thank you, Morning Brew, and thank you guys for joining me today. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts down below on Canadian taxes. It seems to be a really hot topic, and I'm not a fan of taxes. That's not to put that out there. But people do get surprisingly heated about it, even when they're not directly impacted by it, which is not to discourage people from discussing. Just keep it polite, cordial. We're all here to learn, I think. But yeah, would love to hear your thoughts on this big budget change. Thanks again for joining me. See you in the next one.